This week's number, $4 billion. That's how much Americans will spend on chocolate this Valentine's Day season, up 5% over last year. No joke. I did for the first time last night mushroom chocolates. And I like me. Welcome to Prof G Markets. Today, we're discussing the AI wars, Bed Bath & Beyond's share sale, and why I made a trade on that stock's volatility. Here with the news is Prof G media analyst Ed Elson. Ed, what are you doing for Valentine's Day?
I haven't made plans. I have a date tonight though, so that's
So
good.
you're hoping that converts into some sort
What are
of
you doing?
Valentine's Day thing. That's pretty optimistic.
Yeah. After one day,
Yeah.
we'll see what happens.
Go ahead.
Can you explain your psychedelics experience last
I'd
night
hardly
in
call it
some more
psychedelics.
detail?
It's mushroom chocolate. So as I'm getting older, one of the reasons I work out a lot, one of the reasons I try and eat fairly well is so I can drink. I really enjoy substances. I think substances get a bad name. Most of the headline news around substances is how it results in abuse or living under a bridge. And I realize that in moderation, substances can actually enhance your life. Now, having said that, my primary substance or drug of choice is alcohol. But as I get older, I think you need to kind of decrease your alcohol intake. When you're your age, you can just drink a shit ton of alcohol. You wake up the next morning, have a Big Mac and a Diet Coke and a couple of Advil, and you're off to the races. If I go out for a big night now without alcohol, I feel as if I've had a chemotherapy blast for the next 2 days. So I'm trying to take that down, and I substitute it with THC, mostly edibles, that I do once or twice a week. It helps me sleep, helps me relax. And my friend had mushroom chocolates last night, so we tried those. And I found it just sort of this light THC-like high.
Was that your first time doing it?
Yeah, I hadn't done mushroom chocolates before. I'm at an age, I'm not really up for trying new shit. It's got to be in a controlled environment. It's got to be stuff that's been sold through a store or something. That I think my friend got these in Colorado. But I have trouble relaxing. Should I say that? Do I have trouble relaxing? No, it's mostly just about hedonism. But it's nice. It's a nice kind of wavy feel. But you hear the term mushrooms. Last time I'd been mushrooms was in Joshua Tree. And I threw up, and then I just couldn't stop laughing. It was so much fun. And I was with a bunch of college buddies. I think it was my senior fifth
That's
year.
awesome.
And I would ask you if you've done mushrooms, but I'm economically secure, so I can speak openly about my drug use. You shouldn't yet.
Yeah, exactly. No
But yeah, it
comment.
was nice. It was fun. It was easy. And I'm trying to, like I said, I'm using it as a means of trying to reduce my alcohol consumption, which I think is actually harder on your body than THC. Enough about that. And by the way, just a quick tip on Valentine's Day. My girlfriend told me that she didn't want to do anything for Valentine's Day. She said, let's agree to do nothing for Valentine's Day. But what I didn't realize is that she wasn't talking about gifts. She was talking about sex. Okay. What else? Tell us about what's going on in the markets here.
Let's start with our weekly review of market vitals. The S&P 500 was volatile as earnings rolled in. The dollar bounced on signs of a strong labor market and continuing interest rate hikes. Bitcoin dipped below 23,000 to a 2-week low, and the yield on 10-year treasuries rose. Shifting to the headlines. Turkey's stock exchange suspended trading after 2 catastrophic earthquakes sparked a $35 billion sell-off. That's the first time the exchange has shut down in 24 years. As a follow-up to our discussion last week about the Adani Group Hindenburg short, Gautam Adani's bankers sent him a margin call asking him to put up more than $500 million on a personal loan after his stock plummeted. Instead of posting more collateral, though, he simply wrote them a check of $1.1 billion and repaid the loan in full. For an explainer on margin calls, check out our episode from October 17th. CVS is acquiring Oak Street Health, a medical care company, for $10.6 billion. Uber reported record revenue, up 49% from a year earlier, and said it expects to achieve operating income profitability this year. Meanwhile, Disney beat on sales and earnings. In the first earnings call since his return, CEO Bob Iger unveiled a restructuring plan, which includes cutting 7,000 jobs and $5.5 billion in costs. $3 billion of that will come from content. The company is also reorganizing into 3 units: entertainment, ESPN, and parks and experiences. Disney stock rose about 6% in after hours trading. And the next morning, activist investor Nelson Peltz, who we talked about on this podcast, said, quote, "The proxy fight is over." Scott, what are your thoughts?
A lot there. I mean, the first is obviously we hope the best for the rescue efforts in Turkey. I think there's, the small silver lining around these types of natural disasters is the West, and generally most nations, try and rally around nations that have experienced some sort of natural disaster and send help. I always think that's a nice moment that everyone sort of puts aside their bullshit. Anyways, I think that's somewhat of an opportunity, and that is for the West to really weigh in and help them with whatever resources they can. The Adani Group, it's a
Mhm.
baller move. I think is this, the stock is up. I still think that I would bet it's probably a good time to go short the thing now, because paying off this loan doesn't do anything about the corruption. It just provides liquidity or reduces the debt and voids a margin call. CVS is super interesting.
Mhm.
CVS is a management team that's like, yeah, we're just not going to, fade slowly into the sunset here. We're going to do some baller moves. It's still a very big company, decent market cap, and they're kind of forward integrating or reverse integrating into actual healthcare. They have those minute clinics or whatever they're called. They're trying to get more involved in insurance. They're taking advantage of the fact they have such incredible custody of the consumer. And that's become paramount. And that is,
Mhm.
if you own the relationship with the consumer, you can sell them other things, you can steer them towards different products and services. So that's an interesting acquisition. I don't know much about Oak Street Health and whether they overpaid or underpaid. The one that's super interesting, Disney gets all the headlines, but the one that's more interesting relative to the news was that Uber revenue up 49% year on year. And I don't know, some of that must be price increases. Do you know how much the rides were up, Ed?
I don't have that data.
ChatGPT would know it. They would know what the fuck was going on here in about 0.00055 seconds and not asking me for pet bereavement leave. So look, Uber is just a juggernaut. In the quarter, Uber registered 2 billion trips, which is just dramatic. And they have, I guess in 1 month, they had 131 million people take Ubers, which is just, I mean, this is, at the end of the day, my buddy Richard Kramer at Arte, I never know what the fuck. Change your name, Richard. Anyways, it says that Uber is essentially a marketplace pairing buyers and sellers, in this case, people who want a ride and people who are willing to give them a ride. But they have, when you think about it, a great interface. They have your credit card and they make it a very seamless market transaction, in this case, ride hailing. And his thesis all along was that they'll be able to get into other things. But this reflects pricing power. It reflects that there might be a light illuminated at the end of the profitability tunnel or the tunnel towards profitability, because if they can grow their revenues like this, they should be able to become a substantially profitable company. And my sense is they're just rolling over everybody. I don't know if you remember it, but 3 or 5 years ago, people would say Uber and Lyft. Now it's just Uber. It really is. It's Lyft is kind of
Mhm.
a pimple on the elephant or an afterthought. And then the Disney thing is sort of interesting. We got that prediction wrong. I predicted that Disney would put Peltz on their board. They did not. But it's pretty obvious they came to some sort of accommodation. And my guess is that Iger called and said, "So you want us to find efficiencies? That's your kind of your big thing here. You want us to buy the rest of Hulu? Well, actually, we're contemplating selling Hulu, and I'm going to lay off 7,000 people, cut 5 billion in costs. Does that feel right as rain to you?" And my guess is Nelson said, "Yeah, that feels good." And then Bob said, "I don't want the distraction here. I'm giving you. You can declare victory. It can be your idea if you want." And the stock will
Mhm.
go up, which it did. I think immediately went up 8%. I think it's come back a little bit today, but it's still up. So it's sort of a win for Peltz. It's a win for Bob Iger, who's seen as decisive after kind of, I shall return in his first action as CEO, or big action, stocks up. So it feels like win, win, win all around.
Do you own Disney stock yourself?
I don't. I love the stock. Actually think it's a really good buy down here. I know it's bounced back a little bit, but there's just very few companies that have this diversity of reliable, robust cash flows. I mean, ESPN has gone down
Mhm.
in value, but it's still, Americans love to sit on their fat asses and eat salty snacks and drink beer and watch other men give each other Parkinson's. Too much, Ed. Too much.
Just right.
That's a great business. The Disney parks are singular. I just there's no. I mean, what's close to Disney parks? I mean, maybe MGM Universal, maybe, but they only have one or two. And what is close? Magic. I used to go to Mountain when I was in high school because they had those rides that would make you throw up, and it was cheaper. And then I went to Kings Island when I was a kid in Ohio, but nothing, is like nothing has the flywheel effect of Disney and their characters. The movie franchises they have between Star Wars and Pixar and Marvel. I mean, they just have so many assets and so many moats around this business and such pricing power. And then Disney Plus has cost them a ton of money because they've had to go toe to toe in this crazy nuclear arms race that is content spending on streaming. But Disney Plus, sends a very clear signal about what it is. And I worry that actually Hulu doesn't send that clear a signal. It's very dependent upon individual hits. I do get my live TV through Hulu. It's very expensive, but that's how I get live TV. So I pay $85. So occasionally I can watch Anderson Cooper or the State of the Union address. Worth it. Worth it. Because I don't know if you know this, Ed. AC and I are very close. We're very good friends. So I just feel like it's the right thing to do. Anyway, but it's an unbelievable asset. And I think the stock's off, a third or 40% or something. I think Disney's a great long-term hold, and it's going to give Bob. It's a chance for him to come in and kind of clean up the company in 2 to 3 years, and then declare victory and leave with
Yeah.
50 million bucks. So, but the long answer to a short question: I do not own Disney stock.
Okay, let's move on to our first story. Microsoft and Google both held events last week unveiling their new AI-powered chatbots, and it was a tale of two stocks. On Tuesday, Microsoft showed off its search engine Bing with new AI capabilities thanks to a partnership with ChatGPT. Microsoft stock popped more than 3% after that event, bringing its market cap above $2 trillion for the first time in months. A day later, Google revealed its own chatbot, Bard. However, after this announcement, Google stock fell nearly 8%, erasing more than $100 billion in value. We'll get into AI in a bit more depth in a second, but Scott, why do you think there was such a divergence in the market's reaction here to basically the same announcement?
I think people are looking for reasons to like Microsoft and not like Google right now because the general consensus in the market is that Microsoft is ahead of the game here and has made some visionary early investments and has sort of this, I don't know, maverick feel to it right now because it has less to lose. One of these companies has 93% share of search, and one of them has four, I think, and the rest is some other whatever it is. You know, People are looking for reasons to like Microsoft and not like. And the Google launch felt hurried and reactionary and catch up, and then a self-inflicted wound. I guess the question they asked it about the Webb telescope that that actually got wrong. So this feels like people are looking for a reason to take Google's stock down, and there really is an existential threat here, and that is if you spend a lot of time on ChatGPT, which I would suggest everybody do, and if you have the money, $20 a month, such that you can use it anytime and feels more powerful, or actually, I don't know why you paid $20. I did, anyways. And then because that's how I roll.
Yeah.
Actually, I was probably under the influence of mushroom chocolates, but the people are looking for reasons. I mean, think about this: if Microsoft launches, or I believe when Microsoft launches Bing powered by OpenAI or whatever they're going to call it, Bing GPT. And Jason pointed out that so far the demo is a big head fake. You're not really demoing it yet. But if it gives you one really good answer, which is kind of what a prediction engine should do, you could see Bing's share quintuple overnight, which would really cause some excitement around Microsoft for a number of reasons. And then, whether that holds that share or not, remains to be seen. But the market anticipates that. The market anticipates that Microsoft is in the best position to leverage the excitement around artificial intelligence and has kind of a first mover advantage here. And I think that's reflected in the stock price. And so I don't think it was necessarily that one thing. I think people are looking for excuses, and anything that represents a tangible threat to search is very ugly for Google shareholders. Do you have any thoughts around this, Ed?
Well, I found one quote that Satya Nadella said really interesting. He said, when he was talking to the Financial Times, he said, from now on, the gross margin of search is going to drop forever. And he was saying this proudly, that he's basically going to use AI to bring up the costs of search, because it needs to be more sophisticated now. You need to hire sophisticated engineers to build these products, and basically saying that just by bringing up the costs of search as an entire sector, that's going to basically give Microsoft some sort of edge over Google. And all that I can glean from that is he just wants to disrupt Google in any way possible because of that 95% market share. And it doesn't really matter how he does it, even if he pays tens of $billions to acquire ChatGPT. But yeah, I think that sort of falls in line with what you were saying, that anything to begin to eat Google's lunch, and that's a positive sign for Microsoft.
Yeah, I think what he's saying though is that in so many words is that Google is about to lose their monopoly. And the primary means of establishing monopoly abuse is pricing power. And so when he's saying margins are about to come down in search, what he's saying is the company that controls 93% is going to have to lower their prices because they're about to get competition. In addition, the dynamics or the complexion of the business model of search could change dramatically when you're just offering people one answer as opposed to 15 different answers. I mean, it's just fascinating. If you look at search over the last 20 years, it used to be initially kind of Google was you type in something and it would have two heavily shaded answers at the top. And they said add. It's like, okay. And you would ignore them and go to the next ones, the organic links. And then slowly but surely, they lightened that shading to the point where you didn't know what was an ad and what isn't. And on some searches, if you type in best hotel in Orlando, the entire first page, two-thirds of it is going to be links that people are either paying for or taking you to places that Google can further monetize, like their
Mm-hmm.
hotel booking engine. And the idea of just trying to present one answer is an existential threat to Google. In addition, the processing power, my understanding, is costing the single digits of cents to actually process the query, whereas Google, I think it's 1/7 the
Mm-hmm.
cost. So costs going up, margin power or pricing power going down, more competitors. The player here, and I'm an investor. I'm an investor in Yahoo. I partnered, or
Wow.
I know the guys at Apollo, and they give me an opportunity to invest in it. And I've always loved Yahoo. Yahoo is my home screen, and it's very old school, but I still think Yahoo does the best job on finance. And I like the people there. I like the content. I always thought it was kind of undervalued as an asset. And Yahoo purchased it from Verizon, and so I called them and said, could I co-invest and try and add value? Anyway, I would argue that Yahoo should be partnering with, chatbot Joey Bag of Donuts or whoever's doing an interesting job. Maybe it's Alibaba. I don't know who it is who has some interesting, and just put it front and center because they have a lot less to lose. Yahoo is 1% share, and it's even at 1% share, it's still a very profitable business. But I would have thought that they have a lot of leeway to do some really interesting stuff around AI.
Yeah. Yeah, a couple of things. One, it's so interesting, that point about ads, because something I hadn't thought about is there's definitely going to be a way for these companies to pay their way into the ChatGPT answer. I mean, if you ask ChatGPT, what is the best hotel I should stay in, who is it going to choose? And I wonder if that's going to cause a lot of controversy over giving this definitive, confident answer from your AI assistant, but who told the assistant to say that? And then the other thing about uh, these other companies getting into AI, that is happening. So Google and Microsoft are the leaders, but lots of other companies are building their own chatbots. So last week, Baidu, which is sort of the Google of China, they unveiled Wenshin Yiyan. That's their own chatbot. It's going to launch in March. Alibaba is also announcing it's releasing a chatbot. Meta actually had a chatbot called Galactica, and that was released in November. Almost immediately, though, Galactica started spreading misinformation and hate speech, so Meta had to take it down. Um, but then there are all these other companies that are working on AI for other functions. Snap's using it for augmented reality, Apple's using it for Siri, and even they said car crash detection technology in the iPhone. Amazon has a whole suite of AI services for AWS. And then there's this giant ecosystem of startups that's popping up. VC investment in generative AI has increased 425% since 2020. So this entire tech wave is moving really quickly. And my question to you is, have you ever seen a hype cycle move as fast as this one?
Oh, never. I mean, war's broken out here. There's been AI around for a long time, and then ChatGPT comes along, and it just is set up an arms race. And you can bet that every one of these players is like, wait, we've been working on AI, and these guys come out and dominate. I mean, just dominate the headlines. And you brought up something before, and that is, will money begin to pervert these
Mm-hmm.
answers? And I think there's a chance. The big opportunity here is around business model, and that is the thing that really has fucked the internet and society is that Mark Andreessen didn't build in better
Mm-hmm.
micropayments. And the reason why is the internet has basically now been totally fueled and financed by advertising. And when it's an ad model, it's an attention model. And when attention is the primary, is the goal, the motivation, the resource, the rare earth material you're trying to mine, the algorithms say, well, how do we just capture more and more of people's attention? And it's like enraging them, showing them weird content, conspiracy theory. The subscription model, while there's some downsides, you create two worlds, one people who can afford subscriptions and one who can't. But in general, it's a much healthier ecosystem. LinkedIn, which gets about 2/3 of its revenue from non-advertising based cash flow streams, is not nearly as toxic. The GRU has not weaponized Netflix. You're more focused on adding value to the consumer instead of trying to figure out a way to serve up more consumer attention because your end consumer is the advertiser. So it's a better business model. So I would argue if OpenAI, which was initially created to try and protect the world from some of the externalities of artificial intelligence, if they want to stay somewhat true to that mission, which they've already shit canned as they smell Benjamins, they would really try and encourage and show a future around subscriptions, figuring out ways for people to motivate people to pay $20 and then just having a compact with the consumer that Google has broken. We're going to take you to the best place. We're going to try and give you the best answer, not the answer that gets you to go somewhere else we can further monetize or the answer that someone is paying us to give you.
Mm,
So I think the key is around incentives and a subscription model.
yeah. Which brings up all these questions of what is the best, though. I mean, with just a simple question like, show me the hotel for me when I visit Dusseldorf in a week. You know, there's mo- there's money in that in that answer either way. So yeah, I mean, it feels like there's going to be so much pressure, probably a lot of regulatory pressure as well, on transparency about how those decisions are made. And you could give the best answer, but ultimately, you know, ChatGPT will be the arbiter of who receives payment from you when you go stay in that hotel.
Yeah, but if they're not getting a kickback, if they're not getting a commission, it should they may not get the right answer, but if they're just
Hmm.
getting a subscription, you just pay once
Hmm.
for $20 a month, their heart's in the right place and they're going to try and find you the best answer, not that the
Yeah.
Soho House Berlin is paying them. I mean, you realize if Google can get you to go to their booking engine for a
Hmm.
hotel, when you type in best hotel in Munich or Dusseldorf, if you book through Google's booking engine, they take like 20 or 30% of the cost of that room. So they have huge incentive not to have you go to a third party article. And plus, any of this is just a lot of clicks and a lot of diligence. Whereas I think sort of the dream of ChatGPT, beyond the fact it should be solving or curing cancer or helping people with much more important issues, but you can see a day where you say, okay, I'm a 23-year-old, reasonably successful professional who wants to spend between $200 and $300 a night in Germany and want a kind of hip, young, fun vibe in a good area, whatever it might be. What is the best hotel? It
Hmm.
can take all of those words and the way that they're constructed and placed next to each other and find and then scan every data review set of Condé Nast Traveler articles and probably more importantly, TripAdvisor reviews and say, it always gives you a condition that says, hotels are a matter of personal preference and you should always check, blah, blah, blah. And then it'll say, but based on your query, people
Mm-hmm.
in your position, in your
Yeah.
price point, have enjoyed the following 3 or 4 hotels, and then a brief description of why. I think that's really valuable. And they may get it wrong, but they can say our AI generated cyborg Terminator 3 Skynet heart is in the right place.
Mm-hmm.
We're generally trying to give you our sense after examining all the data sets out there and all the reviews
Yeah.
around hotels. This is what we think the best answer is.
Yeah. And our business model proves that. Yeah, it's a great point. I mean, it feels like it has to be subscription for this kind of product. But anyway, we do have to move on. So let's move on to our second story. US retailer Bed Bath & Beyond, which is on the brink of bankruptcy, just secured more than $1 billion in an equity sale. The investor behind that capital raise is Hudson Bay Capital Management, which has provided $225 million up front and up to $800 million over time in exchange for convertible preferred stock. What is convertible preferred stock? You can think of it as a hybrid between debt and equity. It's slightly riskier than a regular loan, as you're not the first in line to get your money back in the event of a bankruptcy. But the upside is that if the company survives, you can convert your investment into regular shares. So Bed Bath & Beyond will use that cash to pay off its creditors. Last month, the company missed its interest payments and defaulted on its debt. So this round of financing really is a lifeline. Scott, this deal definitely makes sense for Bed Bath & Beyond, but Hudson Bay is essentially investing in a dying, almost dead company. Why would they do this?
So the key there is that you said it's a hybrid and it's debt, and that is a lot of people look at this and say, okay, they're just pouring good money after bad. But here's the thing: one of the wonderful things about America is not that we embrace failure, but that we tolerate it. And that is no better depicted or epitomized or reflected in our bankruptcy laws. And that is, we say, okay, Bed Bath and Beyond, you're a $7 billion company or revenue company. I don't know what the annual revenues
Yeah,
are, but
I think it's 7 billion, and with a market cap of around 300 million.
right. And it's got 760 stores. So, but bankruptcy is essentially says there's chapter 11 and there's chapter 7. Chapter 7 is this shit makes no sense. Close it down, put a lock on the door, sell the furniture, and get whatever pennies on the dollar and give it back to the debtors. And it's important to notice that the debtors are first in line. You get any money from selling the company or figuring it out, it goes to the creditors, to the debtors first. And then the equity, the tail of the whip, who demand higher returns, get totally wiped out in a bankruptcy. So retailers are sort of purpose built for bankruptcy. And that is what you get to do is if you declare bankruptcy, you get to go through those, what do they have, 760 stores, cherry pick the ones that are working on a four-wall unit economic basis. And that might be 300 of them and go, okay, 300 of these stores are still very profitable and get out of all the leases. And typically, or oftentimes what drives a retailer like this into bankruptcy is these 10-year lease obligation payments on a store that isn't working. If you're paying $300,000 a month at the West Coast Plaza Mall for your Bed Bath & Beyond there, I mean, you might be losing $100,000, $150,000 a month, and you have to staff it. So you might be losing, millions every year, and you're going to lose millions every year for the next 6 to 8 years until the lease comes due again. So with bankruptcy, you get to go lease by lease. So equity gets wiped out, but then you get to go lease by lease, pick the ones you want to hold on to, and then go to your debtors and say, we can't sustain this debt load. We're going to convert it to equity in NewCo, and you're going to reduce the debt load. So we have lower lease payments and we have much lower debt interest payments. And now we have a company that might actually be reborn. So chapter 11 is there's still something here. It's a good company. There's good assets, a good brand. It's just got a bad balance sheet and really bad lease commitments. So retail typically makes for great candidates for bankruptcy. So they look at that and they think, okay, if it goes bankrupt, we don't convert these shares into equity, but we get some, most, all of our money back. And if this $7 billion retailer shows any signs of life, it might become worth, say, 1/10 of revenues, and we
Hmm.
double our investment and convert to stock. So convertible debt in a situation like this can actually be quite lucrative. The downside isn't as great as people think. It's not going to go to zero because they're in the creditor bucket, if you will.
Mm.
And there's real upside if this thing shows any signs of life. So these aren't dumb. There's a big industry around convertible debt for struggling retailers. I mean, this company probably has a couple $1 billion just in inventory that they could sell off in a fire sale.
Hmm. Yeah, you mentioned on our editorial call earlier that you've had experience with this personally, specifically with Eddie Bauer. Could you take us through what happened there?
Yeah, so Eddie Bauer, iconic retailer, opened a bunch of stores and was struggling. The creditors and investors asked me to go on the board and help them work through bankruptcy filing. And again, got to go through, pick the stores we wanted, and we knew there was value there. So the Eddie Bauer brand, we could have just sold the brand to a licensing company who would put the brand, lay off all the employees, close all the stores, and put the brand on backpacks, fishing poles, fishing vests, flannel shirts. And the brand alone was probably worth somewhere between 100 and 300 million to a licensing company. So there was value there. It just didn't make any sense in the context of a larger company with all these expenses. With I think it had 1,200 employees, a bunch of stores. So I went on the board there, and we did in fact take it through bankruptcy. It came out of bankruptcy. A private equity firm bought it, thought there was real potential. I believe the debtors got all of their money back. Most of the employees held their jobs, and then again, I think it went bankrupt again. I was well off the board by that time. Unfortunately, I have personal experience here, and that is a company I started, Red Envelope, in 1997, went public on the Nasdaq in 2002. Just the land of like all bad karma for me. Interesting warfare on the board. The credit crisis in 2008, longshoreman strike, a software glitch at the fulfillment center, and we started sending out gifts to the wrong addresses. And Wells Fargo pulled our credit line, and boom, we were literally Chapter 11 in like what felt like 72 hours. It was probably 72 days. So all of the equity holders, including yourself, get totally wiped out. But all
Hmm.
the debtors, that is the people who have shipped you products and haven't been paid yet, the employees, everyone got paid because Liberty Media came in and bought the company for more than the debt or more than the money was owed. So no one got laid off. The equity got wiped out. And then it kind of went on because there was value in the company. That was very painful for me because obviously all my investment was reflected in the form of equity. But bankruptcy is, I mean, it's a feature, not a bug of American society. It says, okay, even if you're in over your skis, even if you have a bad balance sheet, even if you have too much debt, if there's value here, we're going to try and figure out a way to hold on to the value.
Hmm. The difference here that I'm seeing is that there's this new instrument or there's this new thing called a meme stock, and
Mm-hmm.
that is what Bed Bath and Beyond is.
Mm-hmm.
Um, and I do. That's a compelling argument that you've made that Hudson Bay actually likes this company and they're making a long-term investment play. But do you think there's also a possibility here that Hudson Bay sees this meme stock as sort of a meme stock engineering opportunity that they can capitalize on the volatility and then eventually dump it on retail investors? Do you think that's a realistic outcome?
I don't. So the answer is I don't. I don't know the folks at Hudson, but my guess is they're saying if for whatever reason Reddit takes a shine to this thing again, and the meme stock animal props up its head again, and for some reason Bed Bath and Beyond skyrockets for irrational reasons, then great. I don't think they're
Hmm.
counting on that. I would call that's sort of a low probability, high upside outcome. But I don't think they're making the investment assuming that it's going to become a meme stock again. But I'm sure in the back of their minds, they're like, okay, there's a 1 in 10, 1 in 50 chance Reddit gets all hot and horny for this thing again, and the thing goes to 10, 15, $20 a share. We convert and get the hell out of Dodge. More power to you, young people who think you're sticking it to the man. So I'm sure that's like part of their quote unquote calculation, but
Hmm.
that's not the reason they're making this investment.
Yeah. So, Scott, yesterday in our editorial meeting, we were discussing this Bed Bath and Beyond news. and you described a trade that you'd made on the stock on BBBY, a pretty big trade. You actually have $900,000 on the line. So we obviously found this fascinating, and I think our listeners would be interested in both the mechanics of this trade and your rationale.
I wrote 4,000 contracts or sold 4,000 put contracts, which is the equivalent of a put agreement on 400,000 shares with a strike price of 250 expiring Friday at 4.
So let me just unpack that. A put is a kind of option. It gives
Mm-hmm.
the buyer of the put the option to sell you shares of Bed Bath & Beyond at $2.50 at any point during a given time frame. In this case, the time frame was what you set, 4 days. In exchange for that option, the buyer paid you 25 cents per share. Now, the buyer is betting that the stock is going to drop below $2.50 because if it does, they can buy the stock at the lower market price and immediately sell it to you for $2.50, i.e., they win. If it stays above $2.50, though, the put simply expires and they'll lose because they paid you 25 cents per share on that option for basically nothing. Each contract is an option on 100 shares. So at 25 cents per share, you sold each contract for $25, and for 4,000 contracts, that means you were paid $100,000. The risk, though, is that if the stock goes below 250, you will have to honor the contract and buy it at 250. So if the stock goes to, say, 225, you'll break even. You made 25 cents per share when you sold the puts, but now you're going to lose 25 cents per share when you buy them back. If the stock goes to zero, which isn't likely, but it's your worst case scenario, you have to buy 4,000 worthless shares for $2.50, which costs you $1 million. And that's against the 100,000 that you made when you sold the puts. So that's a net loss of $900,000. Do I have that right?
That's exactly right.
Okay. So one more thing before we talk about your rationale here. There's some lingo that can make this confusing. Strike price, that's a term people might be familiar with. That's the price that the put buyer has the option to sell at. In your case, that was $2.50. Then there's the premium, and that's the amount that you actually sold the put for in the first place. It was 25 cents per share, but that's not something you get to decide. That's set by the market, just like the price of a stock. And finally, these were put options. The other kind of option is a call option. That's an option to buy a stock from you instead of sell it to you. Otherwise, it works the same as a put. Someone buys a call option if they think a stock is going to go up, because if it does, they can exercise the option at the strike price and then immediately sell it at the higher market price. Okay, that was a lot.
Mm-hmm.
Scott, the question here is, why did you do this?
So I never traded options before, and I started doing it as a hedging strategy. When stocks were really high a couple of years ago, and I thought meme stocks were just ridiculous, I started writing calls. There's a psychology effect here that I think benefits someone who writes options. Now, what is that? The majority of the new money into the market is young retail investors who I would loosely describe as stupid. And that is one, they're looking to get rich quick, and two, they have no perspective of time. They don't realize how quickly time goes. So, what does that mean? They want to buy call options. They want to get rich quick. And they don't realize that if they buy an option that expires in 30 days, that 30 days is going to go much faster than they think. In addition, the people who are writing the options, there aren't that many of them. One, you have to have a decent amount of wealth because whoever is your broker will do a scenario, worst case scenario, and say you would have to come up with that money. So in this case, my broker, Goldman Sachs, says you could lose $900,000. Do you have it? Because we're going to have to honor this contract. So we need to make sure you have it. So that limits the number of people who can write contracts. And also the institutions with the deep pockets, a lot of them, especially hedge funds, have it in their investment documents that they're not allowed to write options because of the volatility. So I like the asymmetry here. Where you make money is when there is an imbalance in buyers and sellers. When there's nobody who wants to buy condos in Miami in 2010, that's when you want to buy. When everybody wants to buy beachfront real estate in Palm Beach, that's when you want to sell. When there's an asymmetry between buyers and sellers. I believe there is an asymmetry between the people who want to buy options and the people who want to sell them or write them. Now, what I do is once a week, I look at the most volatile stocks. Because if you're going to buy an option, you're believing it's going to move substantially because there's certain premium you have to pay for time value. So if you're writing an option, you just want nothing to happen. You just want time decay to take value down, if you will. So the most volatile stocks require that whoever's buying the call or the put have to pay more to the person who is writing the call or the put. So when I saw
Mm.
that Bed Bath & Beyond plunged 45% because it looked like it was hurtling towards bankruptcy, I thought two things. One, it takes longer than people think for this to play out, even if it's on its way to bankruptcy. The stock on Tuesday was trading at $2.62, and I could get 25 cents for writing a put that expired on Friday at a strike of 250, meaning that if it did not go down by 15% by Friday, I make money. If it stays the same, I make all the premium. If it goes up, I make all the premium. If it goes down 12 cents, it's still above 250, I make all the premium. If it goes down to 225, I still make money until 225 and then I break even. It could go all the way to zero, right? And then I could potentially lose on 400,000 shares, 225, $900,000. People want to avoid pain so much. It's a basic human attribute that they avoid things like this. So I think it's what I call a good trade on a risk-adjusted basis. So I go out, I write the put because I believe the likelihood of the stock going down 15% in the next 72 hours is less than people think. And I'm going to get good premium because to find people willing to write a put on a stock like this that is so volatile and has so much negative news, they have to pay me a lot. Now, having said that, you can get hurt really badly. A couple of things. I do this every week. I do it for 1 week terms. You get more of a premium for short term. And I do it directionally against stocks that I think are usually going down. So I usually write calls. And I usually use it as a means of hedging my long positions. I only do it. Two key things here. One, don't try this at home. Unless you have substantial capital, you probably can't do this, but B, you don't want to. And two, I don't spend more than 30 minutes a week on the phone or examining this or looking at this. I don't want to spend a lot of time thinking about this. Every Friday afternoon towards the close of the market, I talk to my broker. I look at the most volatile stocks, and I usually write calls. Sometimes I write, in this case, puts. And I did this on Tuesday when I saw so much action and so much movement. But what you want to do is you want to model a scenario. If you decide to do this, where the stock goes to zero if you wrote puts, or it triples or quadruples if you write calls. Technically, your losses are unlimited. Your potential for losses are unlimited on calls because technically it can go to $1 million a share. So you have to model out a black swan event and assume a black swan event and assume, okay, it's okay to be bummed, but it shouldn't change your life. And I model those things. So losing $900,000 is my maximum out of pocket. And that would be a bad day for me, but it wouldn't change my life in any way. And I find I'm disciplined about this. I do it across 2 or 3 stocks every week. And generally speaking, despite some very ugly weeks that really give you some indigestion, I've been writing calls or shorting Truth Social for a long time. You think, wow, Scott, you've made a lot of money. Yeah, over the long term. But in 1 week, when I wrote calls against Truth Social, it went from 50 to 95. And I had to write a really big fucking mushroom chocolate layered check for that person who showed up and said, okay, I get to buy, you have to go buy these and I get to buy them from you at $50. And I think I got maybe $3 or $4 in premium. Anyways, I find if you're disciplined in this market with a lot of new money into the market, a lot of volatility, and some flaws in our species, specifically a willingness to do anything to avoid pain, and two, poor calibration of how fast time goes, I find this is a really good strategy. But again, this is not for the weary or for people who don't have strong stomachs. Two, do not spend a lot of time thinking about this. And three, make small trades that even if they go horribly wrong, is not going to impact your life. But I made a trade. It's now Thursday at 262. I think the bankruptcy, if it happens, is going to take a lot more time to play out. And I think the volatility gives you incredible premium here. So I felt like this was an asymmetric trade that benefited the person willing to write the put.
Sort of a personal psychological question. When you lost all that money on Truth Social, did you tell anyone? Did you talk to your wife about it? Sort of, did you get it off of your chest in any way, or did you just sort of eat the loss and move on?
I'm transparent with people in my life about my wins and losses, but I aggregate them.
Hmm.
I won't talk about stuff in the moment, like, oh, I lost this day or I made this day. I find that people, generally speaking, talk a lot more about their losses. I remember my mom's friend. My mom lived in Vegas, and her friend was always talking about all the money she made in slot machines. I'm like, well, she's omitting when she loses because over time, it's impossible to win in slots. I just don't care who you are. Um, so yeah, so I'll be very transparent. This year to date, I'm down. But I find that one of the things you have to do as investors is be very unemotional. I think this strategy works. So I'm doing this every week. And at some point, if I kept losing week after week after week, I'd have to stop for financial reasons. But I've been doing it every week for the last 3.5 years. And when I look at the whole year, even though I'll have some very ugly weeks, when I look at the whole year, the premiums have outweighed, sometimes significantly outweighed, what I've had to write checks for. So again, it's being unemotional, sticking to your strategy, trying to really ignore your emotions and your instincts because the market doesn't care about them. And your pain avoidance is so great that it'll influence your strategy. But I don't update anybody on my daily trades. And I
Hmm.
try to, I don't want to say be psychopathic about it, but sociopathic about it. I think about it an hour a week when they come due and when I want to renew them because you have financial capital and you want to put that at risk in smart ways. And I would argue, generally speaking, this strategy does not make sense for the majority of people out there. It's a way to hedge, it's a way to take advantage of volatility when you have a substantial asset base and can afford to take fairly dramatic hits and not have it affect you. I don't think it's the right strategy for someone your age, but it's
Hmm.
an example of a market where you're tapping into what I think is a flaw in the species in terms from a psychological standpoint, and there's an asymmetry in the market here amongst buyers and sellers. But no, I'm
Hmm.
not. I'm not updating anybody. I update people in my life, the key people who matter to me, about how we're doing long term and what
Hmm.
have you. But I don't come home and say, "Oh my God, I lost this,"
I
or "I
lost
made,
everything.
honey, it's champagne and cocaine for dinner." That's just not how I roll.
Do you have options positions in any other companies right now?
Yeah, I wrote it options. I wrote what's called a covered call option. So I wrote options exactly equivalent to my position in Airbnb. In my bigger holdings, I think of them as apartment complexes. And the way I collect rent is I sell out of the money calls. So even if, so say Airbnb is trading at 120, if you write an out of the money call at 130, if it goes to 135, you technically just gave up the upside because the underlying stock goes up. But if it doesn't go to 130, you collect a little bit of rent every month. And I've been doing that every week on my biggest holdings for the last 2.5 or 3 years. And that's worked out. It's called covered calls. That's not as risky. You technically give up some upside if the stock surges, but I generally think, okay, I'm going to write a call that's 3 or 5% out of the money. And if the stock doesn't go up 3 or 5%, I just collect the premium. Some weeks are tough. You're like, oh, it's a bummer to have missed out on the upside. But over time, I find if you're disciplined, you collect rent on that
Mm.
stock.
Mm.
And I also, I'm sorry, last thing, the meme
Yeah.
stocks,
Yeah.
AMC. Right now, I have a position in AMC. I wrote calls against that. Whenever there's a big move up in any of the meme stocks, I write calls against it. I think these things are just shitty businesses that occasionally Reddit and hormones among young people who don't understand the markets get excited about.
Okay. Well, you'll have to tune in for next week's episode to see how Scott did on this
Yeah,
trade.
these are famous last words. These are.
Yeah.
This feels really uncomfortable, to be
I
honest.
kind of just want to check in on these trades every week now. We should create Scott's options section in this
Well,
podcast.
we had that. Someone made an anti-Galloway index because I made a
Yeah.
terrible call on Tesla. Most of the other ones I said were going down have gone down, but Tesla went up 700%. So the anti-Galloway ETF
That
was
well,
down.
that index is bullshit though. That has, just so everyone knows, that index basically emitted all of your wins. And it's just, I mean, Yeah, sorry,
Well,
that index just pisses me off.
since Tesla, even with its recent run up, has gone down 66%. I noticed the people tracking this index decided to stop tracking it because it didn't
Yeah,
fit their narrative.
yeah, exactly. And
Anyway,
now, it's been overtaken by the anti-Jim Cramer index, which is funny, but again, that guy's actually pretty smart and has actually made a lot of money and have made a lot of good trades. I mean, anyway, that whole meme movement pisses me off.
uh,
But maybe I'm just protective of my boss. Anyway,
turn to mushroom chocolates. It'll help deal with that anger.
let's take a look at the week ahead. We'll see the consumer price index for January, as well as retail sales, business inventories, building permits, and housing starts data. And we've also got earnings from Airbnb, it's a big holding of yours, Shopify, and Roblox. Do you have any predictions for us?
So my prediction is, I used to think Disney was going to acquire the rest of Hulu. I think Disney is going to sell Hulu. I've never thought that Hulu has its kind of center of gravity. Disney needs to reduce its balance sheet. It has a great, very well positioned, clear signal, clear reason for being streaming network with Disney Plus. To me, Hulu is sort of the island of misfit content. I don't quite get it. Occasionally they have a hit. I think they've done some good work, but I don't. This feels to me like a company that's not obvious Disney should own. They think they can get 20 billion for their stake, selling it to Comcast or someone else. So I think Disney is going to sell its stake in Hulu, not buy it. And also, and you pointed this out to me earlier in the week, the Warner Brothers Discovery has totally done a 180 on their stated strategy and said they're going to keep Discovery Plus a distinct streaming network. And initially, they'd announced that they were going to bundle it to make this one kind of omnibus jumbo, Canis Mas Macho streaming network with a lot of stuff on it.
Yeah.
And they've decided not to do that. And I think that reflects a couple things. One, I think it reflects that they overpaid for Time Warner and they know it and they have too much debt. And that debt is really beginning to weigh on them. And two, the reason they're keeping it distinct is that they want to package it and sell it.
Mm.
I mean, that would actually be a great acquisition for Disney because rolling Discovery content into Disney Plus would be very creative and on brand. And, Shark Week fits with The Mandalorian and Disney and kids and all that. But I think that this is a reflection that or acknowledgement they vastly overpaid. They need to begin divesting assets, and they're going to package this thing, pretty it up, and sell it because Disney Plus does not have the scale to survive on its own. So, two things: you're going to see Disney sell its stake in Hulu, and you're going to see Warner Brothers Discovery sell Discovery Plus.
It's so funny because, a year ago we were launching the CNN Plus show, and
Oh yeah.
the rationale for shutting that thing down was, you know, Zaslav was like, we don't want to have a standalone streaming product. We want to roll everything up into one.
Yeah.
So we're going to shut this thing down. And no longer.
Yeah, well,
Doesn't make any
when
sense.
the markets change, people change their mind. But
Yeah.
David Zaslav had about a 60-day honeymoon to buy a Porsche and a big fat mansion in Beverly Hills and pretend he was the next Jack Warner. And then all of a sudden reality set in and he, like AT&T, realized he vastly overpaid for these assets. And now he's got to do a yard sale. And front and center is going to be this old rocking chair called Discovery Plus.
Mm-hmm.
That was a
All
shitty
right.
analogy. Ed, we got to do better. That's the mushroom chocolate speaking, Ed. You think you're more creative, but you're not.
You had a good one the other day. It was you called it the Maltese Falcon made of plutonium.
There you go. That's right. Oh, that's right.
Yeah.
There's only one Maltese Falcon. He got it. He bought it. He started petting it and found out it was made of plutonium. And now he's got blood blisters all over his face and leukemia.
Nice.
Little much. Little much.
That'll get clicks.
All right, that's all for this episode. Our producers are Claire Miller and Jason Stavers. Benjamin Spencer is our engineer, and Drew Burrows is our technical director. Special thanks to Catherine Dillon and Mia Silverio. If you like what you heard, please follow, download, and subscribe. Thank you for listening to Prof G Markets from the Vox Media Podcast Network. Join us on Wednesday for office hours, and we'll be back with a fresh take on markets every Monday.
Nice.
Jesus Christ, let's just pray. If the thing goes to zero tomorrow, it's gonna be rough.
Not me. If it goes to zero, I make $223. Boom.
Jason, Jason, send me. Did you get it? Jason's like, fucking Jason takes the other side of the trade and sends me the
That's
trade
right.
confirm.
Balling out.
That is so Jason. I'm like, oh, he thinks his boss is smart, and I'm like, oh wait, he bought calls, or wait, no, he.
I bought your contract. I am.
That's right. You're on the
trade,
other side of
you
the
are winning
trade.
right now. So,
Yeah,
yeah.
you bought puts. Yeah, I haven't followed it. The key is to not look at it. You just can't look at it.